Welcome to This Explainer. Today, we're unpacking the upcoming SpaceX IPO, which is hands down the most anticipated public offering in human history. On the surface, it feels like this really simple, inspiring story about building rockets and eventually colonizing Mars. But as we peel back the layers today, you're going to see that the financial reality underneath is significantly more complex.
Let's just dive right into this massive target valuation, $1.75 trillion. To put that staggering number into perspective, at this price, SpaceX would be worth more than every single American defense contractor combined, plus Coca-Cola, McDonald's, Disney, Nike, and Starbucks all stacked on top of each other. It is an absolutely astronomical figure.
Which brings us to a pretty shocking premise. You might be wondering who on earth is actually buying a company that's currently losing $5 billion a year at the highest valuation in history? Well, the answer is you. Yep, you and your retirement account. Whether you realize it or not, you are about to be one of the biggest buyers. Section 1. 3 businesses in 1. Opening the SpaceX Matryoshka doll. Okay, to understand exactly how you become the buyer, we first have to crack open the illusion that SpaceX is just a rocket company. Think about it. If you ask people on the street what SpaceX sells, almost everyone's going to say rockets. But look under the hood. Rockets aren't actually the main engine here. What we're really dealing with is a bundled telecom, AI, and rocket enterprise, all stacked together like a giant puzzle. Let's start with the part everyone already knows, the rocket division. Obviously, it's incredibly famous for launching government satellites and NASA missions, but it only generated roughly $4 billion in revenue last year. In the grand scheme of a $2 trillion price tag, that's a relatively tiny fraction of the pie. That brings us to the actual crown jewel of the company, which is Starlink. Entrepreneur Scott Galloway hit the nail on the head when he described it as a wildly successful differentiation in telecom. Basically, Starlink is answering the question, what if Comcast, but in space? And they are scaling faster than any telecom company in human history. We're talking over 10 million active subscribers across 150 countries, bringing in a projected $11.4 billion in 2025. But the real magic is the efficiency. Their profit margins expanded from 41% to 63% in just 2 years. Starlink is literally the ultimate cash printer.
But then we have the third business, xAI. This is the artificial intelligence lab founded in 2023, which SpaceX recently acquired in a $250 billion all-stock deal. You can basically think of this division as the reverse Jerome Powell. Instead of printing cash, it's a massive cash incinerator, just lighting whatever money the rest of the business generates on fire.
The math on xAI requires some serious suspension of disbelief. The market is valuing it at an astronomical $250 billion, despite an estimated revenue of just $1 billion. When you place that next to established AI giants like OpenAI or Anthropic, the discrepancy is just glaring. It's being priced like a premium market leader, but the actual revenue numbers tell a completely different story.
Furthermore, this astronomical price tag was paid for an asset that is actively bleeding over $1 billion every single month. And to make matters worse, by March of 2025, every single one of the 11 original co-founders had literally walked out the door. Company leadership has even publicly admitted that the asset needs a total rebuild, straight from the foundation up.
Section 2. A $5 billion loss. The hidden rot in the bundle. Let's see how this massive cash burn complicates this entire public offering. So, despite Starlink and the rocket business actually clearing roughly $8 billion in profit, xAI completely ruins the party. When you consolidate all these entities, that AI cash burn dragged the combined company down to a massive $5 billion net loss last year, and that's despite generating $18.5 billion in total revenue.
Section 3. Changing the NASDAQ rules. The trap door is opened. So how exactly does a bundled company that's losing billions become the biggest stock listing ever, heavily supported by your retirement funds?
Well, the answer lies in some highly convenient regulatory changes that were adopted on May 1st. They essentially rolled out the red carpet to engineer forced stock market demand. Under the old rules, SpaceX's target configuration wouldn't have even qualified to join the NASDAQ 100. Under the new rules, they suddenly fit perfectly. Let's break down this newly adopted fast entry rule. Previously, a newly listed company had to wait 3 months to be added to the index, giving the market time to discover its actual fair price.
This new rule compresses that entire safety buffer into just 15 trading days, meaning newly listed companies can siphon automatic demand from the $600 billion tracking the Nasdaq 100 almost immediately.
And buried in the technical language of these new rules is an absolute shocker. SpaceX is targeting a very small public float, meaning only about 4 to 5% of their total shares will actually be available to trade on the open market. But because of a new hidden multiplier rule, ETFs are legally required to treat those tiny available shares as if they were 3 times larger. They have literally manufactured massive demand out of thin air.
Section 4. You are the exit liquidity, the hard truth about passive investing. Okay, let's dive into what all this engineered demand ultimately means for you and your 401k.
SpaceX is dumping an unprecedented 30% of its initial public offering supply directly onto retail buyers. While most IPOs allocate just 5 to 10% to everyday investors, the SpaceX CFO confirmed they are targeting 3 times that amount, citing loyalty from retail buyers.
But the mechanics happening behind the scenes here are stark. The buyers and sellers don't show up at the same time. Early buyers are forced in via index inclusion, while insiders sit comfortably on a very low-cost basis. They simply wait patiently for their shares to unlock and then offload them to passive funds and retail investors at the absolute peak valuation.
Portfolio manager George Noble bluntly summarized this setup, stating, "Your 401k is the exit liquidity." Simply put, this means you are the guaranteed buyer at the end of the line, allowing early insiders to cash out safely. Because of the mandatory index rules we just discussed, if you have a retirement account holding broad U.S. stock index funds, you're going to be forced to absorb these shares at peak valuation without having any real choice in the matter.
The whole set it and forget it feature we love about index funds, the low fees, the effortless diversification, is the exact same mechanism, now being weaponized to automatically purchase unprofitable companies with your money, completely without your input. So I want to leave you with this final thought. The next time you review your seemingly simple retirement portfolio, you need to ask yourself, is the effortless promise of passive investing actually turning you into Wall Street's forced buyer? It's a wildly complex reality beneath the surface. Thanks so much for joining me for this explainer, and definitely keep asking the hard questions about your investments.